Good afternoon, everybody, and welcome to Trade Smart Tuesday. Now, today we were going to be talking about how to tell when a stock is overextended. Now, this is a topic that came from one of our members uh, in our Discord chat. We have a private Discord chat for our premium members. And for those of you that are interested in checking that out, I will put the link down here into the comments so you guys could go check that out later on. Uh, and let's let's hop into the discussion here. So, how can you tell when a stock is overextended? I'd like to use a recent example of a stock that I've traded. Some of you might be familiar with it. It's a stock called NVIDIA. So let's bring up NVIDIA. So here is NVIDIA. And I've turned off the annotations on here, but I do have the pattern recognition. The reason why is because I like to draw all of my charts, and quite frankly, they could get a little noisy if you're anyone that's not named Michael Lamott, but that's neither here nor there. So here's what we've got going on. So scrolling back to, let's start right over here. This is considered a first stage base. And what we're going to talk about first in how you can tell whether or not a stock is extended is analyzing the base count. So, one of the things that William O'Neill talks about, William O'Neill, for those of you that don't know who William O'Neill is, uh, not only was he considered the perhaps the godfather of growth stock investing, he also wrote a number of books. He also founded Investors Business Daily and came up with this system for finding growth stocks called Can Slim. Now that's not a weight loss program. Can Slim is an acronym for the common elements that growth stocks had before they made their big moves. And so he would look at things like earnings and sales and whether or not the company had something new about it. He would also look at the the chart, right? The supply and demand of the chart, whether or not the stock was a leader, whether it had institutional sponsorship, and also the market in general. He would look at all those things, and the reason why was because historical precedent. That's what the stocks that made moves like this in NVIDIA, right? When I look this way, the screen, anyway, sorry. So, where was I? When stocks would make moves like the one here in NVIDIA, they would typically have all of those qualities, or at least the vast majority of those qualities. And so, if we start off by looking for stocks that had these can slim qualities, then we would be more likely to be fishing in the right pond. So that's where he started, and he would look at uh, the bases, the different bases. So we have a few different bases here that this pattern recognition has found. And shout out to my friend Brendan Shapiro for building this this indicator called Base Finder that I believe you could get for free on TradingView. So it outlines a few different bases here, and this is well, what it's identifying right here is a double bottom, and it's first stage double bottom, which means that it's the first base that it's made in its uh, in this move, right? And so it prices come off the bottom over here, and this is the first time that it's made a base pattern since coming back up through the 50-day and trading above the 200-day moving average. So here it's the first stage base, and the reason why, and I hope that you follow me with this. The reason why we're interested in base patterns is because the further along price gets in its run, the more bases it'll have. It's kind of like if you were to climb a mountain and you climb up the mountain and then you get to a plateau. And then you continue to climb and then you get to another plateau. Well, eventually you're going to run out of plateaus and you're going to hit the summit. That's the big part of the idea of what happens well with stocks. They'll climb and they'll climb and then they'll plateau and then they'll climb some more and then they'll plateau and then they'll keep on climbing and eventually you hit the maximum summit, at least for a while. And so that's the rationale in counting bases. But it's not just rationale, it's not just theory. This is what O'Neill observed after studying more than 100 years of charts and many thousands of market leaders. So that's one way to tell if price is getting extended. If it's late in the base count, then it could be in extended territory. Now, over here, when NVIDIA, and I apologize that I keep on looking to the other side, the way that I've got my screen sharing set up, my screen happens to be over here. So I'm sorry if that's a little weird, but well, what the pattern rec is picking up over here is that this was a third stage base. So it was the third time that price had consolidated and was getting ready to move. Now, does that mean that NVIDIA is later in its run? Yes, it does. Does that mean that it's destined to fail? Well, obviously not. I pulled out about 50% out of this move. So just because something is later in its base count doesn't mean that we shouldn't trade it. But it is something that we do at the very least, want to be aware of. And if we are counting bases, if we start to get into the third stage base, like this one is a third stage base, if we start to get into the fourth stage, fifth stage, sixth stage, right? Some stocks can run for a very long time. We want to have an awareness of what stage we're in. I'll also mention too, well, one of the things that I personally look for beyond the stage count is also the quality of the base. So if a base is wide and loose and all over the place, then I won't touch it because those ones tend to be failure prone in and of themselves. But when you have a constructive base, well, that's a different story. I find it very interesting that the pattern recognition picked up two bases here, right? Do you guys notice this? Do you notice this? Let me know. Type into the chat. Let me know that you're alive, right? Because half the time I'm talking here and I feel like I'm talking to myself. So if you're there and you're watching and you're listening, just type something into the chat. Let me know that you're alive. Say hello. Let me know where you're from. Anyhow, back to what we've got going on here. So we've got this flat base that it started to form, and then later on it identifies this larger cup and handle. Well, I'll tell you something about this first base here. That first one is kind of wonky, isn't it? Well, you have this flat base, so it starts out with this long, wide bar, sells off on pretty hefty volume there. And then what happens after that? Well, price bounces around for a little bit. Volume is still pretty high. It comes back up here, then it falls all the way back down. And so price hasn't really stabilized yet. And that's problematic. That's problematic if you're going to try to trade something because you don't know which way price is really going to move yet. You don't know which way the scales are tipping. It's only when we finally get to this point of the chart, right? Now, let's not even talk about all this mess going on down there. But when price finally rallies from here and then it starts to tighten up, now it's giving us something that we can sink our teeth into. And that's part of what creates a high quality pattern. And that's the reason why I ended up buying this one right here as it emerged and held it up to this point here. I actually sold not at the top. I should have sold at the top. I should have listened to that little voice in my head that said, hey, you just hit 140, sell your last piece. But I decided to hold on to it, and I ended up selling at the end of the day on this day down here. So about a 40% gain on this one. Anyhow, so that's base count. That's the first thing that we're starting to consider is the base count. Are we getting extended in the run? Take a look at the base count. Count how many bases there are. If you start to get into 3, 4, 5, somewhere in that ballpark, then yes, you are late. But that doesn't necessarily mean that you shouldn't take the trade. Evaluate the overall structure and then make your determination of whether or not you should take the trade. This base, right? Base, not much of a base there. I didn't take this one at this point back in April because it wasn't well formed. But then later on, when the base pattern improved, I bought it in the middle of May. So any questions at this point? Get your questions in. Let me know if you have any questions. And also, by the way, if you're not already on our newsletter, subscribe to the newsletter, marawealth.com/newsletter. And while we're at it, why don't I go ahead and put this into the chat? Okay. So the next thing to discuss here. Distance above key moving averages. How to evaluate the distance above key moving averages to gauge an overextension. That's something to monitor as well, because if price is getting extended, then you're more prone to a pullback. Now, what does being extended above a key moving average mean? Well, what's extended and what's a key moving average? Both of those are very interesting questions, aren't they? So now let's tackle the key moving average first. The way that I look at and consider a key moving average is looking at the ones that price tends to adhere to. Now, you could go a little overboard with a statement like that and start flipping your moving averages on every single chart. So that's not what I'm talking about. I don't mean looking at NVIDIA and putting a 5. So I've got a 5 EMA and a 10 EMA over here. This one down here is a 21 EMA. So I don't mean flipping over to another stock. Say you're looking at Apple, and instead of using a 10 EMA, you want to use an 8 EMA. That's not what I'm talking about at all. What I'm talking about is keeping the same moving averages that you typically use and keep them static on your chart, meaning that they're there all the time, and then seeing how price behaves around those. And then depending on its price behavior, you'll see which one is key for that particular stock. Now, for this one, for NVIDIA, the 5 EMA and the 10 EMA were key, right? So the 5 EMA, and I'll zoom in a little bit more so that we can see, price was adhering to this for the entire move, right? For the entire move, it's holding the 5. Every once in a while, it'll dip below the 5, and it will come close to the 10 EMA. That's key. That's key because it's not violating those. It's coming close to it, but it's being contained within them. So when that changes, that gives us a sense of, okay, something's different here. The character is starting to change on this name. And so that's something that tells us that perhaps prices overextended. At prices that, so at this juncture over here, you would start to say, okay, prices showing signs that the character has changed. But here's something else. take a look at the moving average that's being held, that's being adhered to. Take a look at the length of that moving average, right? So we spoke about the 5 EMA. We spoke about the 10 EMA. So 5-day exponential moving average, 10-day exponential moving average. So how long was price sitting above the 10 EMA at this juncture, right? From the breakout. 24 bars. 24 bars. So more than a month, prices above the 10 EMA without threatening it at all. Right? So that's pretty well extended because you can't hold a moving average forever. So those are the kinds of things that we need to be privy to for all of our stocks. And not every stock is going to adhere to the same moving average. So that's why it's important to when you're looking at the different stocks that you're in to see, well, maybe this one is holding the 21 EMA and it's hugging that one a little bit better. Maybe this one is holding the 50-day moving average a little bit better, right? So that's how you're going to understand the different flavors for the stocks that you're looking at. Personally, I like to trade the same types of stocks, meaning most of the stocks that I'll end up trading typically hold the 10 or the 21 EMA. Every so often, they'll be very strong like this, and they'll hold the 5 for a period. But most of the time, what I'm trading holds the 5 and the 10, the 10 and the 21. So that makes it a little bit easier for me to have that level of discernment of, oh, we're getting a little bit overextended or not. So get your questions in on that. And again, subscribe to the newsletter if you're not already on the newsletter. And this question came initially from Daniel in our Discord group. So for those of you that are interested in the Discord group, I'll post that link once more for everybody. So you could go check out our private Discord. One final point that I want to make on how to tell if a stock is overextended, and that is danger signals. You want to understand and recognize how many danger signals there are at any particular point in time. So if we turn on the danger signals indicator, and by the way, this danger signals indicator is free. Brandon Shapiro also helped code this indicator, and he based it off of the Trading Mind Wheel book. So let me give you the link to the Trading Mind Wheel book, and I'll also give you the link to that indicator as well. So put that into the chat. There's the Trading Mind Wheel book, and let me go grab this link for the indicator, so that way you have that. A lot of people have said a lot of very kind things about this indicator already, so hopefully you guys go check out this indicator. Right, so we have a lot of things going on in the chat today. All righty, so if we come over to here, right, let me advance this one more day. So on this day here, this is showing that NVIDIA had 7 danger signals on the day. Well, when I was trading it, it actually showed, it flashed 8. So let me see if I can bring that up. Does it show it to me? Yeah, there it is. Yeah, so at this point for me, it had 8 danger signals. And so you can see fairly clearly all the different types of danger signals that there are. Now, when it comes to these danger signals, it's not that any one signal is more powerful than another. It's really, well, when you start to get too many of them, that it tends to cause a boat to tip over. So on this day, well, when I sold, there were 8 danger signals. And so, given that price had already had such a powerful move, up 50% in just a few weeks, getting 8 danger signals was another thing that was telling me, okay, we're likely at a juncture where price needs a rest. That doesn't mean the price is necessarily done, but at the very least, it needs a rest. And I don't know how much of a rest it's going to need. Maybe it needs 1 day, 2 days, 3 days. Maybe it needs to rest for a couple of weeks. No idea. The only thing that I know at this particular point in time is that there are 8 danger signals. Price has already moved very far. It's well extended above its moving averages, and it's also been above the 10-day exponential moving average for more than a month. All those things combined tell me it's time to take some profits, particularly as a swing trader. Right. Well, let's talk about that for a moment. So there's all different styles of trading, and how you manage a position will be a little bit different depending on the different style that you are. So let's say that you're somebody that a buy and hold type position trader, and you want to just sit in a trade and let it run for as long as it's going to run. Some stuff comes along with that. You might need to tolerate giving back significantly more profits. I'm not willing to do that. I would much rather have more turnover in my account and not give back profits than to have those larger drawdowns. So that's why I'll scale out on the way up, and then when I get something like this, I'll sell the whole thing. Any questions on that? Let's move on to the open Q&A. So for any of you that have questions that you'd like to post or comments or anything, go ahead and put your questions into the chat box now, and we'll open up the floor to whatever trading related questions that you have. Hopefully you have something related to this stuff, but we'll take all questions now. Let's see. Meta. Let's take a look at Meta, because Meta was another one. Meta was another one that I was in, and I sold this one just the other day. So I believe I sold it either here. No, I think I sold it the next day. Yeah, I sold it right here. Right. So this was one that I ended up taking a small loss on. I bought it right here and I sold it right there. So theoretically, I could still be in this and not have taken the loss. However, on this particular day, there were 9 danger signals. So 9 reasons that, hey, things aren't going well in paradise. Perhaps price falls further and hits the original stop. At the very least, it's unlikely that this is going to turn out to be one of my big winners. So I have a couple of options here. One, I can hold and hope. Two, I could cut this loss even shorter than my original planned stop, take the loss early, and move on. One of the things that I like to do is to cut losses as short as possible, as short and as fast as possible. Ideally, I'll get my stop to break even on day one, and then the trade is essentially risk-free. I look at every time that I put a trade on, the distance between my entry and my stop, I look at that amount as what I'm paying to see if I'm going to be right, or the what I'm willing to pay to see if this trade is going to work. Is this trade going to make me money? Every single trade has that cost. So the quicker I'm able to recoup that cost, the better. And how do I recoup that cost? By getting my stuff to break even as quickly as possible. And it's as quickly as possible because, theoretically, we could just place our stop there, raise our stop to break even immediately, right? No matter what happens. And then the risk is off the table. Well, there's good ways to do that and bad ways to do that. The way that I like to do it, my preferred way is to get my stop to break even when price has had a bit of a move, when it's made at least 1 times my risk. Similar to what happened in NU, which we'll talk about in a second. Let me just write down NU, and we'll go to that one in a moment. But as far as Facebook goes, 9 danger signals, no idea what's going to happen next. But at this point, I know that my biggest winning trades have not had more than 6 danger signals soon after buying them. So that's why I kiss this one goodbye. Now let's take a look at NU. Here's NU. NU, I bought yesterday. Yeah, I bought yesterday as it spiked up, right? Got above this level here. And when price got to this point, I was already up 1 times my risk. Put on my annotations over here. So at that point, I was up 1 times my risk, right? So let's turn off the pattern rec for a sec. Maybe it'll be a little bit clearer. Yeah, so price moves up 5%. It's up a little bit more than 1 times what I risked. I risked 4.5%. It's up 5%. Great. So when that happens, I want to take my initial risk off the table. Why would I do that? Why would I raise my stop so rapidly? Because at that point, if price is up here and my stop is down here, I'm risking 2 times my risk, right? I'm essentially risking 2R. I'm risking my original R, my original risk, plus all this profit. So that's why when I make a multiple of whatever I've risked, I get my initial risk off the table. So I did that. I think I did that in the first 5 minutes on this trade. And then what happened? Price pulled back. It went back through the break even. So I'm out. And then it continued falling the rest of the day. It would have hit my original stop. And on the day, it also generated 8 danger signals. So a little bit on trade management and managing risk intraday, and at least how I go about doing it intraday. So let me know if you have any additional questions on any of that. Otherwise, we'll call it a day since I think we are getting fairly close to the end here. Give you guys one more moment to get your questions in. Once again, anybody that is not on the newsletter, sign up to our newsletter, merrillwealth.com/newsletter. And I think that'll be it. All right. I want to say thank you all so much for being here. And I will see you back here tomorrow for our midweek update. Until then, take care. Much love. God bless.